Okay, I'll back the mic off a little bit. Y'all let me know if that's okay. All right.
Guys, can you hear
Mic a
me?
little better now.
I don't know what is going
Perfect.
on.
Okay, so really quickly,
Very,
I
very
want to
peculiar,
discuss
but
with
the
you guys
screen
what's
is
relevant to
not
you. I want to
moving.
be sure that I present material you get a lot of value from. So if y'all don't mind, I'm going to poll you really quick. It'll take 10 seconds. How many of you guys prefer to trade options, and how many prefer to trade stocks? I don't actually do any
We have
futures
quite a bit
anymore.
delay. Here it is. It's moving a bit slow, so I will have to
Options
slow
or
down a little
stocks?
bit. So there we go, guys. Can you hear me well?
No preference,
Fantastic.
options, both.
So there
Okay.
we go.
I mean, if you're an
So
option
let's just
guy, you're
go over
probably
a
interested in
couple of
stocks
slides, and the
anyway.
most exciting
Okay,
part of the
looks like
webinar
majority
will be
options. So
me
let me give
answering
you
So there we go. This is what
a
makes
presentation on
alpha-wave
options
traders
here.
so different.
And
No software of any kind.
this presentation
No
is called
indicators
Why
of any
Option
kind.
Traders Lose and
Simply
How You Can
learn
Profit from
and
It. And I
trade
know it
your
sounds
price
kind of
action
morbid, but
based on
I mean, I
very
think if we're
simple
honest with
and
each
very
other, and look, we've only got
precise
our last
rules,
initial on here. No one really
entering
knows
markets using market
who you
structure
are.
and
If we're
exiting
honest with
using
each other,
Fibonacci
how many
level.
people in here have
That's all
lost
there
money
is.
trading options? Whether
Nothing
you've been doing it
less,
for a
nothing
month or for
more.
3 years or
So
5
why
years,
do we do
and it's
this?
okay. I mean,
Why is
everyone's
this
lost money in the
so
market, whether you trade stocks, options,
important?
futures, you name it.
Because each and every indicator in the
Okay,
market
so
is
the thing with
delayed.
options, and I've
Each
worked
and every
with thousands of traders over the last
indicator
several years, there are some
shows us how
fundamental
the market
flaws to
moves
options that
after the
make it
fact.
very
The
difficult
only
to make
factor
money
that
in them.
tells
And so
you
if you're gonna, some of
where
this is
the
gonna kind of hit
price
home
is
with you when you
moving
see it, but
and
I
what
want to show you
price
how they're
intends
fundamentally
to do
structured, maybe a little
is
bit different than you
price
think,
itself.
and how you
So
can
let's
take
review
advantage
what
of
had
that structure for
transpired
yourself.
in
So
the
quick
market
disclaimer,
this
obviously everything
week
I present here is the best of
on
my knowledge,
oil
true
and
and accurate, but
S&P.
obviously consult your
This is
financial
what I
professional before
trade
making
in Alpha-Wave
any
Trader
huge
room to
endeavor, and
demonstrate
I always encourage
Alpha-Wave
people to do their
Trader
own
method.
homework. So
So let's take a
the
look.
question
What
I
has
started
happened
with
on oil? This
when
is the
approaching
levels
options
that we're
was, are
trade
they fairly priced?
based
Because
on and
anything
we're
else we
trade and
buy in our
take
daily
trade setups
lives,
from.
price
So let's
matters, right?
analyze the
If you're
price
in the market for an
structure.
SUV
When we
and I
came
bring
to the
you a Chevy
markets
Tahoe
this
and tell you it's for
morning,
sale for
price was
$194,000,
at danger
you're not
zone
going to buy it
level,
from me because the price is
which
crazy.
is
But what we
telling
don't
us
know
that oil,
is, are
1
those
hour
options
chart,
fairly priced?
our
Am I getting
guiding light is
all the opportunity I should for the money I put into
exhausted.
that option? So
The
if
price
you've
is
traded
getting
options, you've
ready to
probably
set up
seen this
for
before or at least
reversal.
heard it. This is the
And this is where
Black-Scholes
the danger
equation,
zone
and
dance had
you don't need to
started.
memorize the formula. You don't
So
need to be a
what does a
mathematician, but
trader
this
do?
is
The
where the
trader who
price of
trades pure
options is
price
derived
action.
from.
The
Okay, so it
trader
is
would
actually a
know
mathematical
that
formula,
conservative
and there's several
structure
inputs,
is
including
to
the
enter
volatility,
only
the rate of
long
change,
trade
the price to
here,
underlying
and this
stock,
is exactly what we
the
had
risk-free rate, how
done
much time to
on
expiration.
our
That's
first
where the
trade
price comes from.
from this
Okay, so
level
when I tell
up.
you I got into options, I mean I
Then we
really got into
babysitted
options,
this
not just follow
fascinating
this line on
chop
this
for the
chart.
next 2
And
hours. And finally, there was
the question
nothing
became,
setting up
are
on
these
oil
premiums
except
fairly priced? Am I paying
endless
too much? Because
corrective
if
flux.
so,
I said there
option
is nothing
traders
here.
should
It's lost
essentially
15 minutes
break
before the
even
close
over
of the day.
time as a
I'll
group.
take aggressive
Okay,
short.
it's just a law
And
of
pay
large numbers.
attention.
Every
This is
trade
very
has a
important.
buyer and a seller.
This was a
In every
trade
trade,
on
someone is
my
going to win
range
and someone
chart.
is going to lose. You
This
buy
is
something, you
what
sell it
I
for a different price.
used
Someone bought, someone sold, someone
for
profited,
all
someone
the
lost money.
trades for demonstration
So
purposes.
by
But
just a
concept
simple law
remains
of
the
large
same.
numbers,
It
it is
doesn't matter if I
predicated
use
that
hourly,
most should
weekly,
break even
monthly.
over a long period. I don't mean
Range
over a
charts
week or a
simply
month or a
give me
quarter,
plenty
but
of
over several
opportunity.
years. You take a group of
This
5,000
was a
option traders,
short.
at least half of them
Where
should
did the
essentially break
short
even.
end? The trading room closes at
But many
12:30
studies have shown that
EST.
90% of option
As you
traders
could
lose
see
money.
on our YouTube channel and
So I began
on
to ask
our
myself why.
blog.
And I think it's important that you
This
do
is
as
a
well,
review
because again,
of
this is your
all the
livelihood. This is
videos
money
that
that you've worked
we
hard for, that
demonstrate
you're allocating
and
into
show
markets,
and record
and
the
you deserve
trades.
to
You can
have
view
the
them
fairest
here
shot at profit from
and view
doing your
the
homework and your
analysis
research
on
as
our
possible. So
blog.
why are 90% losing
But
money?
before I forgot, this is an invitation to Alpha Wave Trading Room,
It's the mispricing of options. And
Mondays
this is
through
what I found.
Wednesday. I look
They're
forward to
not actually
seeing you
priced
there,
correctly. And the culprit here is
where you can
inflated
view
implied
how
volatility. Now,
I
does everyone
trade
know what I mean when I say
oil
implied
and S&P
volatility?
500. Again, space is limited. Room is open only 3 hours a day. I'll be there next
what happens
Monday,
is this
9:30,
IV becomes
trading
artificially
S&P and
skewed
oil.
by market
So
makers.
let's demonstrate why is oil had been collapsing so much, as you can view also
it's
on
especially
our
true on out-of-the-money options. They just tend to be further skewed than in the money options.
From the news event we had on oil.
What happens is this higher implied volatility generates higher option prices.
That you can view
and traders end up paying
channel.
more than they should for the potential gain that they have to make. So what I did, I looked at the Black-Scholes calculator, okay, and I ran a couple of models. So there's a link there. I'm not associated with that site, my stock options. It's just a free Black-Scholes calculator if you want to play with it. So let's assume we took a $100 stock. Okay, that's the current price of the stock. We looked at the $110 call option, and it's 3 months to expiration. And I want to show you the effect of implied volatility on those stocks. So this is a stock, $100. Again, I just put in all the basic inputs, which you can see here. And let me get my pointer out.
There is no such thing then, and that's a mistake that every trader makes. There's no such thing how many ticks you make.
You're seeing $100. You just put in the stock price, the exercise price, the option, the time to maturity is in years. That's why it's 0.25. Annual risk-free rate. I use 2%, maybe a little lower, a little higher, but we use the same thing for every stock.
Boom.
And then just annualized volatility. And you get a price for that option. Now, on the right is the exact same inputs, but with 30% implied volatility. And you see the difference in price of those two options.
And you pay attention that market
now, looking at its ad, $1.04, $2.63. It's not a lot of, it's not a great deal of money, but you're paying over 150% more for the exact same opportunity, for the same profits on the same upside of the same stock, because that IV is 10% higher. And if it really is, then it's worth that much more. But we have to know, are these implied volatilities correct?
For 4 hours, euro is heading to 3800.
This is at 40% implied volatility, and this is after maybe a really bad earnings report or catastrophic news for the stock. It's 80% implied volatility. And look at how high the prices go here. Same stock, same option, same expiration month, everything the same. We're just changing that implied volatility. So anywhere from $1.06 to $12.28,
and so on.
Is how wide the price of these options can be skewed just by that implied volatility.
And then you scale out depending.
And again,
on how many lots
it's
you
all
have.
because of that IV
and
input.
This is heads up.
That's the formula. Everything else in that formula you can't play with.
194.
This is the
where
only
Apple will decide if this trend will be
input
minor
that requires manual
input
with it, because the others are the risk-free rate, the time to maturity, the price to stock, these things are all given non-variables. And again, this is just a look at different implied volatilities of that same stock. What the contract value of those options is depending on what they say is the implied volatility. So hopefully you're starting to realize why this is important and why, if that implied volatility is not right, you can wildly overpay for options or maybe even underpay for them. That's not really the case.
But it's quite simple.
So with the Black-Scholes option model, implied volatility is the only manual variable that goes into that formula. Stock price, time to maturity, the risk-free rate, strike price, these are all known inputs. A monkey could put these in. And this makes implied volatility crucial in determining these option values. Is this making sense to everybody?
Doesn't matter if you trade range bars.
I don't want to lose anyone. If you haven't traded options, implied volatility is essentially just how much that stock moves based on that formula I showed you, and how much the stock typically moves around. And I just wanted to paint the picture of how much effect that one variable. This is not gamma and theta and all these Greeks that require a mathematics degree. It's just how volatile one person says the stock is makes a dramatic difference in what you're paying for this.
This is what we call
once you realize how important that is, the next question pops in your head is, so how is implied volatility determined? Who sets it? How do I know it's correct on the options I'm buying? Because I don't want to pay $12 a share for an opportunity that's only worth $2 a share.
Which is absolutely fantastic and amazing indicator to use.
So in theory, implied volatility is determined by a mathematical formula that estimates the potential magnitude of future price movement of the stock. So essentially, it's a formula that says the odds are this is how far it's going to move.
So there we go.
But in reality, implied volatility of options is determined by the market maker's assessment, public expectations.
S&P had incredibly
Repeat that. Implied volatility of options is determined by the market maker's assessment of public expectations.
Due to the political
now,
soap opera we had.
You guys, when I say market makers, I know we have this image in our head of these evil trolls that crawl out of the woods and come to rob our money, but do you guys know what market makers' actual role is? Because if not, I mean, it's important to understand. They are a vital part of the market.
To 19 points.
Market makers, they are there to maintain liquidity in a market. Okay, so back in the 80s and 90s when everything was done in a pit and this online trading that we're blessed to have in front of us was not available, these guys were in the pits so that trading kept happening.
This trader
and how that works is these guys essentially make the bid-ask spread, right? So let's say he's in the Apple stock pit, and he's the market maker for Apple stock. So right now it's trading what, around 502? Maybe he says, I'll buy your stock for 502 1/4. Or you can, I'll sell shares to you for 502 and 30 cents, right? The spread's a nickel. You know there's a bid-ask spread. He makes that nickel thousands of times a day, and he earns a living by doing that. In order to have that advantage, he must maintain liquidity. And he must be able to buy, he must be willing to buy shares even no one else is willing, and sell if no one else is willing.
And how to apply it correctly to take profit.
So that means, again, like I just said, selling when everyone is buying and buying when everyone is selling. He's the market maker. It is his responsibility to maintain liquidity. So regardless of what he thinks of that stock or that option, he has to maintain liquidity. He has to be the buyer when everyone wants to sell, and he has to be the seller when everyone wants to buy. And these conditions are often referred to as a one-sided market. So like take, I heard Price reference, you know, fall of 2008. Everyone's just buying puts, buying puts. The world's coming to an end, right? Not many people were out there willing to sell puts. So if you came to the SPY, SPY option market maker, and everyone's looking to buy puts, he has to be there to sell them to them.
And very clear.
So when he's forced to sell, and put yourself in his shoes, when he's forced to sell, he wants to get as much money as possible for those options, right? If I told you you have to sell your house next week, you're gonna get less than you think, but you're gonna do everything you can to get as much money as you possibly can for that house. So you're going to use the tools at your disposal, and so is the market maker. And he only has one tool at his disposal to be sure when he has to sell, he gets as much money as he possibly can for it.
So if you know where these levels are, if you apply proper and simple rules.
So remember I told you implied volatility is the market maker's assessment
where to take profit
market expectations.
The table.
He simply increases his assessment of implied volatility, and this makes option prices increase. Right? We just looked at how much implied volatility affects the price of those markets. Right? When one was at 20%, it was $1.06 option, or $106 to buy one. When it was at 80%, it was $1,274 to buy one. So all he's got to do is turn up that dial on the volatility, and the option prices go up. He's a regular guy like you and I, okay? He's out there trying to make money, and all of a sudden, the market says, you've got to buy all these, you've got to sell all these. He's going to jack the price up as high as he can. And it allows him to sell from higher prices and reap larger profits. He's not selling because he wants to. He's selling because he's the market maker and everyone else is buying. Now, on the other side of the coin, when he's forced to buy options, he's going to do the opposite. He's going to decrease the implied volatility, turn that nozzle down, bring option values lower, because he's forced to buy, he wants to pay as little as possible. So it's a very basic, simple premise. People just don't think about how these prices are calculated.
Students who trade stocks.
Now, people often ask, who would buy or sell here? And you see certain conditions, like an example that always comes to mind is, if y'all remember back in like 2009 or something when the news came out that Goldman Sachs was being investigated by the SEC, and the stock just tanked. And it was during market hours, and it just screamed lower, screamed lower, screamed lower. Everybody's jumping in puts. And you're asking, maybe everyone's selling calls or selling the stock. Who's buying here? Who's buying these call options? Because everyone's selling.
A little bit more clarity.
Well, in these one-sided markets, when these events happen, option traders are often dealing directly with the
major
market makers
trend.
instead of another option trader.
And this
Okay, so if you go on Thinkorswim,
trend
you
shows
sell
incredibly
an Apple
clearly
call or an Apple put, or you buy one or
where the
whatever you do in your
inception of the
trading,
trend is,
9
and
times
where
out of
it ends
10,
on level
there's a
bar.
person on his computer
And this
selling
is
an
the most
option. He's got a
critical
bid, you've got the
component.
ask out, y'all meet in the
Once
middle,
you
and
know
you place a
how
trade with another
to
person. But in these
identify the
one-sided
inception
markets,
of
when
the
things
trend,
really get catastrophic,
you can identify
oftentimes you're dealing
incredibly
directly with that
clearly
market
where
maker. And if you've
trend
been trading options
exhaustion
for
levels
several
are
years, I guarantee you
and
it's
what
happened at one
not
point in your
to
trading career.
enter into. That is the most critical component of
This is also why implied
trading.
volatility tends to rise in a bear market
when to stay out
and drop
and
in a
to know
bull
where
market. Now,
to
you've
be
probably heard
excited
other
about
excuses
trend
for why this
inception.
happens, and the volatility.
Everything
And
in
only,
Alpha Wave
if you
Trader
notice the
method
VIX is supposed to measure volatility,
when
how
I
come
developed the method, I
it goes
did not
down
know
when the market
that
goes
Elliott
up?
wave existed.
I mean, volatility
So
is
when I
price
have
movement,
students who
right?
come to me from
If the
Elliott
S&P
wave
goes up
background,
100 points
they
tomorrow,
compare
do you think the
it
VIX is going
to
to move the same as it would if
very
S&P went down 100
simple
points tomorrow?
version of Elliott
No.
wave as
Because what
Alpha
happens
wave
is,
trader
in a bear
method
market,
is
traders usually rush
as
into put
simple as
options all at
that.
once.
Minor trend
I asked you
3
guys about
waves,
trading. Most of you
major
prefer
trend
options.
5.
Maybe you like the leverage.
That's all there
You
is.
like to know that you can put
For
$500 in and pull out
5 waves.
$5,000 if you get really lucky.
So even if you trade
And when things are
markets,
dropping
you
catastrophically,
still
people aren't getting
apply
short
to
stocks. They're jumping into put
levels.
options.
You just have to
And they do it all at
separate
once, and that
and
becomes a
understand
one-sided
when
market. Everyone's
is
buying puts,
in
and
small
now here's this
bending
market
wave
maker who's got to
formation.
sell all those puts to them.
When
So he's
market is
jacking the
forming
implied volatility up as high as he
powerful
can to bring the
trending
prices up as
formations,
much as
like the
possible
ones you're
to
witnessing
lighten his
right
load
now,
that he has to sell.
and the ones we had been witnessing on S&P
Now, in
the
a
entire
bull market,
week,
like we've experienced the last
here's an
several years,
example
the buying of
of
call options
19
tends to be
point
more
run
spread
up on
out and less
S&P
hurried, so you don't
from
get the same
our
thing.
room on
Think about how
October
many people were just
15th.
jumping on puts and puts and puts and
Where
puts in
did
08,
it
09,
end?
how fast the market
Danger
crashes
zone.
versus
That's
how many times
precisely
you've
why I
heard the
named
market is topping
danger
out
zone.
or we're due for a
Trend
pullback, as we've
ended
risen
there. That's where collapse
150% over the
had
last 4
started
years.
overnight.
So is this making a little bit of sense to you? I'm not trying to I'm not trying to paint the picture of the market's this evil thing out to get you. It's not that at all.
Any instrument and
but
any time frame.
when it
So
comes
here
to
we are.
this,
This is what's incredibly critical.
there's actually a little bit of that there, and I hate to say that. I don't mean to be the fear monger guy, but you guys are in good faith putting your money in the market. You need to understand what's happening behind the scenes.
Ouch! Respect where waves.
So when everyone is buying,
nowhere to take
the implied volatility is increased. Market makers receive more money because they're selling.
Simple.
And what happens is traders overpay for their options.
And I demonstrate
when you look at the Black-Scholes model, if you take a stock, and we can get down to a whole new mathematical level and put this into hard numbers, but if you're looking at buying Apple stock or a call on Apple, it's at $500. You're going to buy a 550 call based on what that stock has done historically over different time periods, certain events, any news-driven events that are taking place. The risk-free rate, the price of the stock, the price of the stock option, that opportunity to profit above 550, should it go, can be fundamentally derived to an exact dollar amount that is worth to you. But by this increased implied volatility, that option that was at $2 a week ago is all of a sudden at $8, even though the stock hasn't moved because the implied volatility is going up. And now you are overpaying for that risk. Black-Scholes sets it up so that options are fairly priced. You have essentially a 50-50 chance just by throwing darts at a board of making money or losing money big picture, excluding commissions, because it should be properly calculated. Now, on the other side of the coin, everyone is selling. The implied volatility is decreased, right? When you want to capture that premium, when the market's going up like it has been, you want to sell puts maybe just to bring in income. They're bringing that IV down. So market makers, when they're forced to buy, he's getting more money for buying. He's getting more option for the money he puts out. And traders are receiving less premium than they should for taking on that risk.
Exactly where it ended. Very, very important.
And essentially, and again, I've worked with thousands of traders. I've worked at option facilities and run option programs. I could put 90% of the people who lose money in options
during news time all the time.
I could base their losses on this one simple thing.
And this is where decision and announcement came that
Because in theory, option traders should break even. And don't take this the wrong way. Don't say that, oh, well, I'm just going to best shot break even. No, it's just law of large numbers, right? If everyone in this room flipped a coin, there's 526 people in here. Odds are around 263 of you should get heads, 263 of you should get tails. If 500 people got heads and only 27 got tails, we'd start asking what's going on here. And if it happened for 5 years straight,
if it's time
there'd
for
be a problem.
Exhaustion, doesn't matter what
so in theory, they should lose money. You know, half make money, half lose money, excluding commissions.
That level.
In the grand scheme, it should probably be something like a bell curve. The middle 60% maybe make money. You know, there's a small percentage that lose a lot of money, and a small percentage that lose a great deal of money.
About 15 minutes
but if you talk to other option traders, and if you've been to maybe educational schools or groups where traders get together, meetups, message boards, anything, there's a lot of people losing money in options. A lot of
discussions.
It's over 90% for people that try this. I'm not saying there are people that don't make money in options. There are.
An email,
but they're far outnumbered. And again, this is primarily due to the market maker manipulation of implied volatility.
The only comparison is from students who come from
So how do we become part of the profitable 10%, right? All I've done is tell you the game's rigged against you. I'm not trying to talk you out of trading options. What I'm doing is using this to show you how to get on the right side of this thing.
Once again, very classic and very pure. Here
to become part of the profitable 10%, it's very easy.
A little bit off.
You just trade like a market maker.
Wave 5.
When implied volatility is high because everyone is buying options,
the inception of wave 1,
because the IV is higher than it should. It's like a casino. A casino, the odds are like 50.1% in favor of the house. But when a million people come through the door, that 0.1% adds up to a lot of money. And with options, the same thing. You're putting the odds in your favor.
On Euro Weekly,
you want to use that implied volatility manipulation to your advantage. Capture the premium and give up the pipe dream. Now, what I mean when I say give up the pipe dream, people take this one hard too. And I'll be the first to tell you guys, I try to shoot it as straight as I can, so I don't want to offend anyone with this conversation. I'm just telling you everything I've learned and trying to get it to you straight here. But
and double lot size, scale out accordingly.
I'm going to go ahead and
enter into
kill some dreams here really quickly.
This is where price struggles.
The number of option traders that make 200, 300, 400% a year consistently over many years
level 2
is a very, very small group of people. Now, there are some extremely intelligent traders out there. I heard Price on here. I've heard nothing but good things about him.
On oil and S&P.
But there are very few people who have a consistent track record of making money with that. Of
all
the people I know, the thousands of people that trade options, the ones I know for a fact are consistently profitable tend to be premium
price waves.
They tend to be selling options.
You look on
now,
the price,
they don't double or triple their accounts every year.
You apply Fibonacci levels. You use no
neither do the guys that are buyers. So by doing this, you're getting on the same side as the market maker.
TradeStation, Ninja Trader,
okay, when he's buying, you're buying. When he's selling, you're selling. How many broke market makers do you know?
Thinkorswim, Infinity,
how many broke? Oh, that could be a hot shot traders, do you know?
Free. Fibonacci tool is on any platform.
And I'll issue you a challenge. I forgot the slide was in here, but find at least 5 option traders who have consistently made money. By that I mean 5 years or longer. As a net buyer of options. Okay, someone who buys calls, buys puts. I don't care, you know, what indicators he's using, what he's looking at, in the money, out of the money. Just buys options. Now, if I ask you to find me 5 people who've made money for 5 years in stocks or cars or in real estate or a handful of other things, it shouldn't be a problem. But if you can quickly put 5 people together that you know for a fact as buyer of options make money long term doing this, that should kind of be your first clue that maybe you need to, you know, take a fresh look at what you're doing.
I look forward to seeing you in the trading room on Monday. Can you see my link?
Now, I've gone through kind of the basics of why I think options are mispriced, and hopefully you can kind of see how that can work against you, right? So we're gonna get to how to put that to your advantage, right? How you can make money with this. Am I losing everybody? I haven't seen a lot of comments. I don't want to blow past anybody. Just want to make sure we're all on the same page. Lena, you're with me?
10% of our students learn
so
everything
there's 5 big reasons that option buyers
the other 80% learn
lose money.
Everything within 2 to 4 weeks.
Number 1, option purchases are limited risk speculation. But the limit is 100%, right? You can lose everything you pay for that options.
I'm sure
2, options lose time value from the moment you purchase them.
TradingPub, ladies and gentlemen.
3, commissions on option transactions are typically high, not astronomically high,
So
but compared to stock, you can do futures around 4.25 round turn. You can do stocks for generally like an $8 flat fee.
So
Options usually about $10 plus maybe 75 cents a contract. You may have a better rate than that, but they're a little more expensive than stock transactions, and also option traders tend to trade a little more actively, so it racks up more expenses. 4, options are short-term and they expire. And finally, option prices are not formally related to the price of the underlying stock.
Again,
now they're loosely related to the price of the underlying stock, but as we saw in that implied volatility, if one guy thinks it's really risky tomorrow when he didn't think it was really risky yesterday, all of a sudden that $2 option is now $10. And that's not a formal relationship to the underlying price of the stock if the price of the option can move even when the stock doesn't.
But as you could see, I had shown
so
multiple
what I want to do is dissect these 5
frames.
disadvantages
I will post
and show you how to use those to profit from it.
And I will,
this is the stock market. The beauty of the market is if there's anything you know, you can make money from it.
Out that
if you can tell me how many oranges are going to be harvested in March, we can make a fortune together, right? If you know a stock's going to go up a quarter in the next hour, you can make a fortune from it. And you've got all the tools and leverage instruments to do so. So anything you know about the market can make you money. And what I've showed you here in the first 20 minutes are things you now know about how options are priced. So I want to show you how to use those to your advantage
and again,
turn
all
knowledge
the
into
information
profits.
is posted on our website.
Now, the first one we mentioned was option prices are limited risk speculation,
I look forward,
but the limit
perhaps
is, of course,
we'll do a lot
100%
more
when you buy an option.
analysis in Trading Room.
Buying any option
Monday.
risks losing all invested capital. Selling an option, specifically puts,
the best book you can read
creates
is
immediate
price.
income
Simply remove
and
all the
potential
and
for a low-cost basis to buy a stock.
Price.
Okay, so if you bought
Frankly,
a $500 Apple call right there at the money, if Apple falls $3 by the time it expires, you lost everything you put in.
Thank you, traders.
If you sold,
thank you so
a
much.
$450 put,
it's my pleasure being
you're immediately
here.
paid by your broker or the clearing firm. The money goes right into your account.
Again,
in worst case scenario, you're buying that stock for a price less than you could buy it today,
to send me an
and you're
email
still
with
keeping
any
the
questions. I promise you, I will always answer.
So the option may go to zero.
And you can always listen to audio testimonies.
But I highly doubt a company that makes
$44
billion a year.
My pleasure, Stanislaus.
So a solution for this one: sell options, don't buy them.
Thank you.
Okay, now there are opportunities when buying options is proper, and I'll go over some of that. I actually recommended one in the newsletter I put out about 10 days ago.
Post it one more time.
But just as a general rule of thumb, when we're looking at options, I tend to focus more on the selling side than the buying for these reasons.
Thank you, Jim.
Number 2, options lose time value from the moment you purchase them. It's known as a depreciating asset, which we've all heard that term, right? Your parents probably told you, oh, you save some money, buy a house. They appreciate. Well, other than 2008, 2009, 2010, over history, this has been true. But if you buy a car, if you went out and bought a new Mercedes, are you buying that as an investment? No.
Well, I would love to do that.
Every day you drive it, it's going to be worth less.
And I know that we have next presenter.
You buy,
is that correct?
a new suit or a new dress for an event, it's worth less the minute you put it on. It's a depreciating asset. There's nothing wrong with that. I mean, so are apples and milk and, steaks, lots of things we need. But those are not investments.
ESG.
And options are investments of our money.
It has
so just like your car is going to be worth less every day you own it, all else being equal. But by selling options, this works to your advantage.
Thank you.
Time value decay creates profits for the seller.
So it may be so much better
so if the option, if the stock goes up, you make money. Stays flat, you make money. Goes down just a little, you probably still make money. Goes down a lot, maybe you lose a little bit of money, but you're still in a good position because you bought a stock at a reasonable price.
Again, I will absolutely would love to answer your questions. May I do this, TradingPub?
Number 3, commissions on option transactions are high. Now, stocks generally $5 to $10 flat. Futures, like I said, around $4 to $5 a turn. Option commissions usually $7 to $10 plus an additional per contract fee. Now, there's a few brokerages out there that offer really discount rates. Then you're kind of juggling, what's the platform worth to me? Are the tools right? Brokers, as a rule of thumb, love to promote complex option strategies.
Hey,
How many of you guys have been to an
can you hear
event?
me
Maybe you
very
got an
well?
email from
So there we go.
TD
Let's do a little
Ameritrade or
bit of
Scott
analysis,
Trade or
a little bit
TradeStation or
of
someone.
a
They brought an option guy on,
active market
and
structure, shall we?
surprise, surprise,
So please,
he was telling you how to
yes,
do iron
I had
condors
shown
or
multiple
broken wing
charts on Forex,
butterflies
so
or
please
something
post.
that involved a
Let's
whole lot of
start
legs.
futures, Forex, and stocks. I need the name
And
of the
Simon, I saw you
instrument
also
and the
ask about
time
the
frame
margin. I'm going to
next to it.
cover
For
that in just a
example,
minute. I
Apple
actually don't use any
monthly.
margin, Simon,
As
but
I
I'll
explained
cover that
earlier,
with you.
Apple
Very,
is
very good
heading to
question.
581.94.
And you don't need near $100,000.
SPX, it is ES. I
The
had
more
shown
legs, the more
quite a
con. You
few
guys know what I mean
charts
when I
on
say
ES. By
legs?
the way,
Like if you sold
speaking of the
a put
devil,
credit spread,
this is where
you sell one
ES
put,
is
buy
on
another. It's
daily
two different option
charts.
contracts, so it's
Based on
two
alpha
legs.
with trader
If you get a
method, you had
condor, it's like
opportunity
a
to buy
put credit
ES,
spread and a call
which is
credit spread.
S&P
There's four
500
legs.
future and
The more
SPY
legs that
from
are in there,
922
that's more
area.
contracts, and you got to
This is
pay
where
a commission
S&P
on each and every
500
one of
had
those.
taken a pause
And
at
it creates these big commissions, which is
1033
great for the
level,
brokers.
as you could
That's
see
why they promote these
in
guys. But
2010.
you're not going to see a lot of
Price struggled
brokers
at
promote a
this
guy
level
like
for
me
2
who says
months.
keep your commissions
Here's
low,
decision
watch
point
your account,
2.
keep it
Price
simple. This is how you
struggled
make
at
money in
this level
options.
for how many months, giving us very powerful
So the
pullback
solution,
and
really, you want to
staging
keep
a
it
rally
simple.
that gave a
And I only
powerful
sell
correction.
single options. I mean,
This
the
is
majority of my trading is done
incredibly
just selling naked
important.
puts, and it sounds
All
risky.
the
I
levels
promise you it is
drove
not. I'm going
on
to cover all that.
S&P
Just hang with me
500
for another 20,
future,
30 minutes.
which is exactly
But
identical
when you're doing
structure on
spreads
SPY,
and butterflies and condors and all
at
this stuff,
very, very critical
guys,
levels.
do me a favor.
So
Write
let me
down
give you
the amounts you have in your
projection
account tonight.
if price will break
Your average
through
trade,
this
whether it's a
level.
condor or a
Shall
spread
we
or whatever,
take a
count the number
look
of legs
what
up
will
and the full
happen
commission based on
next
how many contracts you
if
trade.
1728.50
Look at how many trades you do
is
on average week, multiply by
That's
50.
how price
Figure out
moves.
how much
Very, very
ballpark you're
critical
paying
to
commissions every
recognize
year.
and
And what
remember
most people
that.
find is
The next
they're
level
losing like
is
15 to 20% of their
728.50
account
is
in
broken,
commissions.
will be
So not only
1822.75.
you have to make a 20% gain in the market to break even,
Is
not
that
only
clear?
are these options you're getting into
This is how price
fundamentally
moves.
stacked
Keeps forming
against you
waves
so that
and
implied
giving
volatility is going
you
to increase and
next
decrease the
level.
price of options at the
But
absolute
currently
worst
we
time
have
to
been
you as a
at very,
trader.
very critical exhaustion, and
All
that's
these
why
things
we've been
combined
witnessing
together,
this
and then you've still got to make
incredible
20% a year
difficulty
just
for
to
the
start at
last
zero.
5 months on monthly
That's how you're
chart.
rewarded for
And
spending,
if price is
ruining your vision,
breaking
staring
this
at
level,
24-inch flat screen
next
monitors
level
all day
is
long.
1822.75.
So, I mean, if you're making money on the complex stuff, look, I'm not trying to talk you out of it, okay?
Exactly.
Look, I want everyone
We
to
know
profit.
that.
I want everyone to make money and become wealthy. That's it.
So there we go.
That is it. I don't care if you're trading Barbie dolls for a living. If it's working, keep doing it. But if it's not, I want you to look at this stuff because most people don't. They think, oh, I got to get the new indicator, or oh, I got to get a better feel for the market and watch my level 2. Garbage, garbage,
if
garbage,
there's no
garbage.
questions on futures,
George says you only pay for one side of a condor. So if that's true, that's not quite as high. There's still two legs in it. You've still got two options each side. But again, just George, and thank you for pointing that out. I don't want to leave anyone askew here. Just look at your actual cost. I mean, I encourage you to do that. Just do it sometime this weekend. Just so you know for your own well-being.
you had an opportunity to buy
Number 4, options are short-term and they expire. So picking stocks that will go higher is easy.
Would you like to learn why?
And you may be hearing this saying, no, it's not.
Very,
I'm not talking about next week or even next month. But if I say, give me a list of 5 stocks that are going to be higher 5 years from now than they are now, most of you in this room would pass the test, right? You'd probably give me a Google. You'd give me, hopefully not Tesla, it's a sore subject for me. But you can pick Walmart, Procter and Gamble, these phenomenal companies that grow each and every year and produce more and more profits. It's not that tough, right? Picking when they go up is next to impossible.
All the way back in 2009.
And the shorter the time frame you are trading, the harder your life is.
Very, very beautiful pair.
Warren Buffett is an absolute investing legend. He is, I mean, he's it, right? He's the man. He manages $110 billion. His returns over a 50-year period are astronomically phenomenal, beyond the wildest imagination of any kid growing up in Omaha, Nebraska. He cannot tell you where this market's going to be next week. He cannot tell you where it's going to be next month. But he's pretty good at telling you where it's going to be a few years from now, or where certain stocks should be a few years from now.
because price had reached danger zone level.
Option trading is the only arena that I know of where you can be right
acquiring trend
and still lose money.
At these levels is very, very dangerous.
Think about that for a second.
The collapse was drastic.
What other area of your life can you be right on? What other type of business can you be right and lose money? You think a stock's going higher, you buy it to make money. You think the futures are going, S&P futures or soybeans or crude, whatever your trading's going higher, you buy it, it goes up, you make money. You can buy a call option on a stock to go higher, the implied volatility goes down, the stock goes up, you still lose money.
Gold, but I need a time frame, so
and that is just a completely rigged system to me. And guys are going to come on here and tell you, well, you got to watch the theta and the gamma decay and this acceleration of this. No, you don't.
Okay, if I'm not getting any answers,
you can if you really want to get that into it, but you don't need to do that. Selling options completely removes this element of timing.
John C.
You collect premium whether it happens next week or next year. Right? So if you bought a call on Apple at $500, expires next month, it sits flat for a month, and then wouldn't you know it, the day after yours expires, thing jumps $30 a share.
If you
and you think that's not fair. I mean, it went up, you were right, but you can't predict when it's going to happen. But if you sold, a $480 put there, whether it goes up tomorrow or hangs around or whatever, the premium is yours regardless. So again, especially over the short term, I encourage people to sell options, collect that immediate paycheck, and I'll talk about what stocks to do that on, because it's not just sell options on any old thing out there.
I think rally is stalling at decision point 2 for only one reason, because it is
Number 5, option prices are not formally related to the price of the underlying stock. We talked about this with implied volatility, right? It being manipulated by the market makers.
But it's not the most critical level in the market structure.
I'm telling you, I really hate saying that. It's
Gold will migrate all the way to the danger
I hate the guys that come out and say,
all
it's
the way
rigged against you, but I'm going to tell you a secret system that makes it work. It's not what I'm telling you.
Is that
I don't
clear?
have a secret system. I don't have a
But you could see how prices dancing
double
currently
stochastic indicator is going to make
the
your
levels.
life easier.
Reminding you, don't
but
enter
implied volatility is manipulated. And buying when the IV is high,
not into this, not
then
into
selling after it comes down, can result in a
upside,
loss even though you were correct in forecasting the price of the stock.
Danger zone will be your third.
Earnings is a perfect example, right in the middle of earnings season.
Daily.
You buy a call option, yes, they beat, I'm a genius, pay me sucker, it goes up $10, the next day your option's up 10 cents, or maybe it's even down a little bit. Because the implied volatility was at 60% yesterday, now it's at 18, and premium sucked right out of that option.
I use 14-40-minute chart because it gives me very, very precise levels.
What happens with high implied volatility, it creates opportunities to sell insurance and collect large premiums for everyone else's fear.
All right?
And one of the kind of underlying fundamentals of the way I invest, if everyone else is doing it, I'm probably not interested.
Very, very powerful reversal.
One of the best ways to guarantee that you will underperform the market and never outperform it is to do exactly what everyone else is telling you to do. To do exactly what everyone else is doing.
You know better not to
one of Buffett's biggest investments and the thing that really made Berkshire what it is and gave him the ample cash to begin buying other securities and grow what the powerhouse has become.
Gold is forming incredibly spectacular and
premiums and premiums and premiums. It just came premiums, and it generated cash for them to do other things.
Wave. It is not prudent.
And it's the same approach here. When you sell a put option at a stock that's got 80% implied volatility, you sell it a couple bucks below where it is now, or a couple standard deviations, whatever you want to use. We'll talk about that later.
Before you will ever acquire a trade. But this is
see State Farm go bankrupt recently?
Do you know why?
Alpha, Nationwide. Think those guys are doing it for fun?
That's clear. And
we're scared we're going to get in a car wreck, or our pennies is going to rupture, or God forbid we're going to die before our time, and our spouse is going to be without
as a matter of fact,
income.
Don't be surprised if tomorrow is
selling us insurance to do that, and they price it accordingly to where yes, they're going to be there to cover that risk if it comes up. It's a bit of a premium to that. It's a little bit more than the actual dollar cost of that risk is to them. And that's where their profit comes in, and that's exactly what happens when IV is inflated. That risk that the stock's going to come down, you have to buy it, is mathematically found to be, call it $2 a share. But the IV's jacked up. So now all of a sudden you get $4 per share. And over time you're going to make a lot of money doing this.
There's nothing random about alpha wave trader method.
So again, Sell options, definitely sell when that implied volatility is high. And what's high?
So based
look
on
at an option chain
method, you have to wait for
first stock. Like Thinkorswim shows you, each month, and the implied volatility is like over there to the right of the month heading at the top, and shows you what the IV is for that month strike.
Never.
If you see where historically it's like 20, 25, 30, 35, 32, and then one month it's like 60%, that's high.
This
it's all relative.
Same sequence will happen 99.9%
Amazon implied
of the time.
volatility, or like a Tesla or something like that's going to have higher IV historically than maybe a Walmart or a 3M. But look at it relative to that stock. Now, if you still want to buy options, and I admit there are times when options make sense and it's the right strategy, do it when the IV is low, right? Do it when that stock is normally at a 20, 25% IV, and all of a sudden it's like 15. There's no event count. That's when you're getting more bang for your buck.
Bearish day, either tomorrow or Monday.
And George said he can't sell puts in IRA. George, you should be able to sell puts in IRA all day long, as long as you've got the cash there to buy the stock should it be put to you. And I'm going to cover that in a second.
Gives me very precise and very clear view.
Now, naked calls, no, because that's I don't sell calls naked. That's unlimited risk. I mean, you could sell a $100 call, the stock could theoretically go to $1 million.
The stop,
so the broker can't cap his risk. That's why you can't do those.
The application of Fibonacci level.
So just kind of coming together for you guys. Is this making sense? Feel free to shoot me with questions. I mean, I want you to understand this stuff.
Is a bond, ZB, please let me know.
I want to be sure we're on the same page.
I know very little about bonds. Is it ZB?
And if you're a long-time option trader and you think I'm completely, I'm full of it.
There are a couple of different bonds.
I mean, you want to do that. Look, if you're making money buying calls and puts, keep doing it, because you're one of a very few select group of people. So I mean,
So again, tomorrow
you are a rare breed and a better performer than the majority of people out there. So if you've got that gift, keep doing it, because not many people can do that.
Do you know why it started? It's completely expected.
So hopefully you're beginning to see why most people lose money trading options, right? It's not that they can't pick which direction it's going. It's not they're using the wrong indicators, or their moving average was exponential instead of simple, or something ridiculous like that. It's that when they want to buy options, they're paying too much for them. When they want to sell options, they're not getting enough for them. Because the move has already happened, it's been priced in, and the market makers push that IV to the direction to make him profit.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11
and you're seeing how the market is kind of stacked against the retail trader in that sense, as a buyer of options.
Where you had very impressive, powerful buying opportunities.
So, are you ready to make money?
If
you're ready to make money with options,
and apply
you want to take the side of the house to begin making money now. I gave you that example of the casino, right? And when you spin the roulette wheel, what are there, like 36 numbers on there? You spin the roulette, you drop the ball, you pick red or black, or pick a number. There's like 36 numbers, right? So it's like 1 in 36 chance. So you think if you get it right, you get paid 36 times, and you do.
Is that clear?
But what do? They add a 0 and a double 0 up there. So there's actually 38 options.
Massive
but you're paid 36 times. So I mean, you've got like a 48.9 or 49.4%, whatever the number is, chance of making money. But if you sat there
and you're monitoring
and drop that thing and bet on red or black or a certain number, for a year, you would eventually run out of money because the odds are just slightly stacked in the favor of the house. And that's all I'm trying to get you to do with options. Okay, if you happen to be good at picking stock direction, if you happen to be good at selecting good stocks and timing markets well, you can make an enormous amount of money. Just if you're an average monkey throwing darts at a dartboard, by taking the other side and following the market maker, over time, almost anyone can make money, assuming you don't overtrade and kill your profits with commissions. I don't see a short on daily chart.
It's very temporary pullback, and if you know how to trade,
you guys didn't watch this. I sent this out to my database of people over at Blue Tick Research. I sent out a 3-part series called The Income Strategy, How I Trade Options.
Short trades,
and
you're trading way
I kind of wish you guys had seen it, but you're kind of getting the idea now.
It's not conservative.
So the idea behind this is very simple. You want to use market maker behavior to your advantage. And you want to force the market to pay you to do business.
I don't remember when last time I looked on Saving. Hold on. Okay, one chart I don't believe I highlighted is Oil Weekly. Okay, next
Okay,
level on
sorry about
oil
that.
weekly.
So let me give you an example. And this is an analogy I like to use, just a house analogy. I actually didn't even make this up. I saw this somewhere else, but it made really good sense to me.
Based on our monthly chart, this is where collapse
Just go with
has
me for 20
started
seconds
from.
on this. Let's say
Reminding
you found your dream house,
do
right?
not
And it's listed for
exercise greed.
$400,000.
Respect
Now,
this
some
level.
of you fat cats in
Never,
here, maybe that's
ever,
4 million.
ever,
You know, some
acquire
of you may be
trend
younger, maybe that's
position
200,000.
anywhere
Whatever the
near
number is in your
this level.
market, right?
So,
Let's say you
this is
find
where
it and it's
oil
listed for $400,000.
very,
Here's the
very
problem.
powerful bearish collapse.
You only want to
And
spend
based on our weekly
$300,000.
chart, it will head all
So you
the
offer
way
the owner
to
$300,000 for his house. Like, what the heck? You never know.
95,
I'd love to have
level.
the house.
But formula remains the same.
Here's what he does.
Doesn't matter.
You go by his house,
If
tell him,
it's
look, your
range,
house is beautiful.
hourly,
I love to
weekly,
buy it.
monthly,
I don't have
whatever it is.
$400,000. I'll give you $300,000 for it today,
So
cash. I'd love your house. He says, you know
soybeans,
what?
I have to find soybeans
I can't
on
accept
Ninja Trader. If somebody
$300,000.
knows what
But I
that
really
symbol is,
appreciate you
please
making
let
this
me know.
offer to me.
Soybean.
He says, now I've got to move within the next 3 months. So if you'll leave your offer on the table for 3 months, if you'll sit there until, what is it, October, till January 17th, willing to buy my house for $300,000, I'll give you 25 grand to do it.
ZS scrolling
now,
down.
For you,
way, there we go.
this is a fantastic offer.
What time frame on soybean?
Right? Worst case, you keep 20. He doesn't take your offer, and you keep $25,000 for doing nothing. Best case, he sells it to you for $300,000, the house you've always wanted that you think is worth $400,000, and you keep an extra 25 grand. So after 3 months, one of two things is going to happen. You buy the house for $300K, he accepts your offer, and you keep $25,000. Or he says, you know what, look, I found another buyer. They came in and offered $380 for it, but look, I appreciate you coming and making that offer to me. And you keep his $25,000. That's yours immediately.
Soybeans daily.
Now, Gail, I know we got a real estate agent in the room. Gail's telling me it's called the right of first refusal. Thank you, Gail.
Wave 3 is here,
so
guys.
All you're doing is making a lowball offer on this house. The homeowners, or in our world, the stockholders, are willing to pay to have you as an option.
I see that price will find selling pressure very, very close to
people like options
level because it's not far
not stock options, just options in life.
Level.
They're scared.
You could see very, very
they are scared to death that they bought the wrong stock, that it's not worth what they paid for it.
But you could see how hesitant and weak.
How many of you guys? Well, I'll keep going with this.
Rallying up.
In either case, you're going to keep the premium, right? Best case, you get your stock at your price and you keep the premium. Apple's at 500, you sell a 450 put for maybe $10 a share. It falls down, you get it at 450, which is where you want to buy it anyway, and you get another $10 for being the guy that's out there willing to buy. Worst case, you didn't get your stock. You didn't get what your offer was not accepted, but you're still keeping money just for being there. Being a good guy, willing to buy stocks.
Silver.
So why are people willing to do this?
Let me see if I have
why would someone do the house example, and why are they out there paying you for put options?
Silver coming up.
People like options. Okay? They like to know that they have an out. And they're deadly fearful of making bad decisions. Think back to when you first started trading, or when you first started investing in stocks, or managing your own IRA, or maybe you saved some money up. You're like, I want to put it in the market. Maybe you were fortunate enough this happened in like 98 or 99 when everything was just screaming higher.
Coming up.
How much did you know about those stocks? Could you have told me what their free cash flow rate of return is? Could you have told me what their EBITDA growth rate is for the last 3 to 5 years? What their expansion plans are? How much cash they're putting into capital expenditures and acquisitions? Could you told me what their dividend rate is? What the future looks like? How many times earnings you're paying? What their book value was? No. And a lot of you may not be able to. That's okay. But it just goes to the point. People don't know that much about stocks generally when I look at the whole country. Now, the people in this room, most of you are fairly educated in the financial world. You kind of understand how things work. But a lot of people don't. And they're scared to death of buying the wrong stock. They're scared to death of buying one for $100 that comes in it's worth $10 the next day. So to them, paying a couple dollars a share to have a guy that says, hey, I'll pick up your shares, $10 below where they go right here for the next 3 months.
What a peculiar
all day long, they're going to do it. And they're paying for the safety of an escape. They're paying for you to be the guy that says you will not lose all your money in this stock. You bought it at 100. You can give it. You can sell it all to me at $90. I'm going to be here at your doorstep for 3 months, willing to buy those stocks from you. Your biggest risk is 10%. Now give me a couple bucks a share to be here.
Yes, Jerry, absolutely.
So
absolutely. You know the inception
with the income
of the
strategy,
trend,
this is just kind of what I call the way I trade options.
This is corrective.
People like it when you name it something.
Knowledgeable
so
trader stays out because the spectacular
We're doing the same thing but with stocks. We're doing the same thing we do with the house 15th. With stocks. Okay? People will pay us to be their safety net. And for a few minutes, just take everything out of your head that you've learned about options. Forget everything about, theta decay and gamma acceleration and all these things you've been taught and preached to, even though the guys won't show you their brokerage accounts. Forget all this stuff and just think about the very basic concept of what you're doing. All you're doing is saying,
monthly I will do, and then we will go into
I'll buy your
Forex.
shares. I think that's a good price. I'll be your insurance policy.
Monthly chart.
Because again, people don't know much about buying stocks. And that lack of knowledge is what makes them scared.
Of any kind. So
they want to limit their risk and feel safe with an emergency exit.
Bullish correction.
How many of you guys have a parent or a sibling or maybe a child or a neighbor or a coworker, and you're like their go-to investment guy? This is more than likely dangerous on them. Because you know a good deal about the markets. They come to you and say, hey, what do you think's going on in the market? You got any stock tips for me? What would you do with this? I know a lot of you are that guy for a lot of, because I'm that guy for a lot of people. Right? And you've seen there's a lot of people out there that just don't know that much about stocks. And that's okay. I don't know anything about fixing refrigerators. I don't know how to properly do my own taxes.
Once again,
I can't, give myself an appendicitis or appendix surgery, whatever it's called, and I pay people that know. But so many people out there are investing in stocks that aren't knowledge in this field. It creates a lot of fear and a lot of scare, especially after 2008 and 9.
Trend entry.
So let me give you an example. Company XYZ is trading for $50 a share. You want to buy it for 45, right? Let's say you've done your due diligence, you understand a thing or two about stocks, it's trading at maybe 17 times earnings, it looks safe, got a good amount of cash, again, $45, great price for this stock. Like, I'll give you an example, Google. I'm in love with Google. If there's one stock I want to own for the next 20 years, it's Google. It's going to be the United States of Google in the next 3 decades. They're just that amazing to me, right? But I just don't want to pay $890 a share for it. So let's say for this stock you're going to pay for 45. So you make an offer to buy it at $45 anytime in the next 90 days. And to do that, you're paid $5 per share. Now there's 2 outcomes that can happen. That's it. Either the stock does not come down to 45 per share, you keep your $5 you received, and you have no future obligations. Just go about your way with your 10% return.
And in what sequence and mode.
Or 2, the stock falls below $45 per share. The owner is going to exercise that option, right? He owns it. He bought you as a safety net. He's going to use you. So you pick up the shares at $45, but you still keep the $5 per share in premium.
Reminder.
So you liked it at 45. Now you own it from 40. The stock may have only come down to like 43, but you essentially bought it from a price that no one else in the market was capable of buying the stock that much.
When decision point 1 is reached. Very, very powerful.
And this is just a visual representation of that, right? Let's say the current stock is at 50.
How essential and critical
you make an offer at 45. In other words, sell at $45 put. You bring in $5. Gives you a cost basis 20% below the stock, even if it's put to you.
So what is the price doing currently on CAT? CAT is actually staging pretty adorable.
You may offer at 45. You're forced to pay 45. You bring in $5.
This is where CAT is heading to. Next level on CAT is 103.11.
When it comes to stock options, don't misunderstand me. Stock options are risky. It's important to know that. If you don't know what a call is and what a put is, hey, that's fine. No one knew it once.
The next few hours are
I would encourage you just to read up on it. Be sure you understand the possible outcomes of any trade you do, whether it's a futures contract, Forex pair, stock options, stock outright buy, whatever you do. And go to Investopedia.com. There's tons of free resources out there. So options are risky. Buying them to speculate on future price, it's almost a sure way to go broke. And look, we all know someone who bought Apple at $6 a share and held it blindly to today. We all know someone who bought eBay at $2 or started buying stocks in 2008 and caught the greatest bull rally of all time. But the majority of people who are trying to guess on where price will be with no reasoning other than, it's a pretty uptrend and look at this chart pattern it's formed.
I like to use 1440 minute.
When you buy options to speculate on the future price, it's almost disaster for everyone that does it. And
Euro daily, give us
in my
very
opinion,
bearish correction.
and we've gone over why this. We talked about the option
I don't
decay
even have to apply
and
TIPS, to be frank,
the increased
to
implied
see where these
volatility.
levels are.
In my opinion, the
So,
only way to
this is where
safely
euro is
use
currently.
options is to be a net
Very
seller
powerful rally started
and use
a couple of days
options
ago.
to get in and out of stocks. In other
Okay.
words, selling puts to buy
Euro still
stocks
did not
and
make it
selling
to the
calls
danger
to
zone
sell
levels.
stocks.
Euro is heading
Now, if you're thinking
to
selling naked puts, covered calls, that's boring
37.21.
stuff. That's 10-15% a year stuff.
37.21
It's
is
not.
danger zone level. That's where
All
I
you were
expect very,
doing
very
is taking
powerful
what you and I would do, right? Buy and sell stocks.
pullback.
And you're going to the market and
37.21.
you're saying, I'm not just going to buy this thing. You're going to pay me to make an offer
After
at a price
pullback,
below what
I
I
would
can
not
even
be
get it
surprised
for in
the
the
price
market.
will continue
And then when your
further
stock's
up.
going up and you're ready to sell it, you're going to say, not
But at
only
this
do I not
level,
want
I
to sell it at this
expect a
price,
pullback.
I'm going to make you pay me to sell it to you at an even higher price than it's trading right now.
You have to obey
So
four
what you're
rules
doing is
before you
turning
ever
the
take a
stock
short.
market into a
There is
mechanism
nothing
that
random
is
about
forced to
alpha
pay
weight
you
trader
to do
method.
business.
There is nothing speculative.
So let's look at covered calls for a second.
Entry.
And Cheryl, the commission per
Stop,
share,
target,
if you're talking
and
about
fibs.
options, generally, I mean,
there is nothing random. What if
TD
market will
Ameritrade's
give
like
you
$10
only
plus maybe 75 cents
correction?
per
You can't
contract.
enter short
You can usually get a deal to do
if
like
it's a
$1.50 per
fluff,
contract.
and if
You can
you
go to like
will
an
give
Option
you
King or Trade Monster. There's some
consolidation like
discount guys that go
oil is
even
doing
cheaper.
right
But
now.
again,
The smart
we'll
thing
cover
would
all this in
be
just a minute.
to stay
And
out,
you can indeed sell
because
naked
if
puts
this
in an
is
IRA as long as you've got the cash
magnificent
secured there to
you
do
may
it. You
only
may have to call
get
your
a
broker and tell them, hey, this is what I'm
bearish
going to do, prove me for level 3
correction,
trading, but they'll do
nothing
it.
more.
So the other side of this coin is the covered calls, right? It's just the
Dollar,
inverse
yen,
of selling
or
naked
hour.
puts in order to buy stocks at lower prices. This is selling covered calls to get out of stocks at even better prices. So what you're doing, you're again the seller, and instead of selling someone the right to put those shares to you at a price that you'd love to buy them, you're selling someone the right to buy your shares at a price you'd love to sell it. And you're getting paid to do that. The word covered, if you haven't heard this, it simply means that you own the stock, right? Naked put means you're selling a put, you don't own the stock. So if it's, quote, put to you, you have to spend the money to buy the shares.
Absolutely.
Now, a call, we call it a covered call because you've already got the stock. So if it is called away, you're covered. You just give them your shares. That's what that means.
Beauty. Why? Because it was incredibly classic uptrend.
George,
very, very classic.
I don't. Well, I'll answer these in a minute. I don't know what broker you're with, but I mean, I do it
Jerry,
myself all the time with level 3 option and IRA. So we'll take a look at that in a minute.
Very important.
Now let's look at an example of covered call. Say the same one, right? That stock that got put to us at 45 bucks a share. You plan on selling it at 50.
Doing here.
You sell the $50 call for $5 a share.
Reversal.
And once again, there's two possible outcomes.
A couple ticks prior because of
one, the stock exceeds $50. If you sell your shares for $50 or you want to sell them anyway,
only prudent
and you keep an extra $5 per share.
Versus spectacular
Outcome 2, it doesn't hit 50.
That's
maybe it even falls a little.
Very, very
you still own the stock, but guess what? You kept $5 per share just for giving someone the option to buy your shares at a price above what they're trading right now.
Nothing subjective, nothing speculative, and
this is just the inverse of that model. It's at 45. You're putting an offer out there to sell your shares at 50, which give you a selling basis of $55 per share. So it's two strategies we're looking at here. To get in, we're selling a naked put. We're bringing in premium for making a low ball offer on a stock.
You completely expect this pullback.
Go into Best Buy.
Completely.
Look at a 60-inch flat screen they're selling for $1,200.
The next hours are incredibly
Tell them
critical.
you'll pay them $1,000 for that for the next 2 months, and you'd like $50 for being willing to do so.
A bullish trend.
You're going to get laughed out of the store. There's nowhere else in the world you can do this.
This
it's fantastic.
Incredibly critical. Decision
2, when you're selling a stock, you're just selling a covered call. You're bringing in premium for making a high dollar offer to give your shares away at a price above what they're trading today.
If price will continue collapsing.
So you're being paid to buy stocks. You're being paid to sell stocks. You can buy them and sell them at the exact same price and still make good money.
Decision point 1 and decision point 2.
So with this income strategy, both sides kind of accomplish the same goal, right? You make more money for doing what you already plan to do.
The end of the minor trend is here.
Naked puts let you buy for below current market prices. Covered calls let you sell for above current market prices. Now, I wouldn't be
Google. Excellent. What time
responsible if I didn't tell you about the risks in this, because there are risks in everything you do.
Phenomenal rally. Oh my lord, Google.
Unless you're adequate, if you like 1% annual CDs, there's really no risk in that.
Google what time
but
frame?
if you're like me, that's just not going to get it done. So it sounds foolproof as not. This is the risk in this strategy comes from applying it to the wrong stocks at the wrong prices. Okay, now what do I mean by that? What are the wrong stocks at the wrong prices?
All right. I would not be buying Google right now, frankly.
You need to know how to find underpriced stocks. And this is really where the strategy becomes gold. Because if you're doing this, like Amazon, for instance, great company, right? As a consumer, I love it. I can order anything from, toilet paper to an SUV winch, have it delivered to my house in 2 days, read 1,000 customer reviews on it, compare prices. It's a wonderful company. But it's trading at such a high valuation.
I don't
just mean its stock price. I mean it's trading at like 200 and 300 times what it earns every year. And if you sell these naked puts on Amazon, yes, it may stay up there and you may profit from it. But if another 2008, 2009 happens, this stock could get annihilated. And if Amazon went to $50 a share, sadly, it would be kind of justified. If all of a sudden things are trading at 5, 10 times earnings, Amazon's going to get destroyed. And this is where you'd lose a lot of money, okay, because you'd be selling a put on this thing, you're bringing in money, all the examples I've given you are assuming it doesn't fall that much further than where you're at, and that's how it's going to work as long as you're doing this on properly priced stocks, on kind of value investments.
Small time frames, you may get much more clear structure. This is not
so again, don't apply to just any stock offering high premium. By selling puts at a price does not make sense to buy the stock. You negate the power of the strategy.
900 is incredibly critical. This is
so if Amazon gets put to you at 250, but when you do the math as a stock analyst, and really that stock, based on current levels, has a value of like, $100 or something, you're negating the power of the strategy because we only want to do this in stocks that are already undervalued. Stocks that are trading at 10 times their annual earnings when most stocks are at 15 to 20.
I only have
stocks that are trading below book value that in bankruptcy would be worth more than they're trading right now. Stocks that are growing 10, 15% a year annually and are priced like a stock that's stagnant.
The Apple chart we were looking at before.
These are the kinds of stocks that make you a fortune because the premise behind the strategy is you must be there willing to buy the stock.
This is where Apple is currently.
So only use this approach, you can achieve a price that is fair.
It is not weekly, it is not monthly. Next level on this
chart.
And
when I said I don't use any margin, I don't use any margin. I'm not selling a put that would require me to buy, $3,000 worth of stock when I've only got $500 in my account. I'm keeping enough money right there in my account to buy every single one of those shares they're put to me because I'm doing my homework. I'm finding undervalued stocks that I'm willing, ready, and eager to buy should it get put to me, and I'm going to keep that premium.
But this is
most times they expire worthless and I don't get the stock. And it drives me crazy because I want the stock. I did it on First Solar maybe a month ago, sold the $37 puts. It was at 36.5. I sold them in the money. I wanted to be assigned so badly. Now the stock's at $44.50. Yeah, I made $4 a share on it. It's not bad making, a nice little 10% return, no margin in, 45 days or so.
Okay.
I'd much rather be up 30% if I own the stock.
Right.
So it's a very different approach from guys that do maybe credit spreads and things.
Thank you, Valerie.
Who do this strategy and think, oh man, if it goes below there, I'm screwed and I lose money. Not me. I'm picking up the stock. I'm ready to buy it. And it's going to appreciate. When it does, I'm going to flip around. Now the shares are put to me. I'm going to start selling calls on it. I'm going to bring in even more money until I can sell it.
I love classic formation.
To give you some basics, implied volatility, generally to me, high implied volatility in today's market is anything over about 40%.
The bullish trend.
Because I said I like to sell when implied volatility is high. It's going to vary a bit, but to me, when I get 40% or more, that's usually when I can achieve pretty good annualized returns. And the higher that number is, the more, quote, risk the market, or as we learned, the market maker, perceives with that stock.
So there we go.
And therefore, people are going to pay you more to be their safety net.
On weekly charts.
That's, if they're buying Walmart stock, they're not too concerned the stock's going to crash. If they're owning Amazon or, I don't know, one of these high flyers, maybe Stratasys, the 3D systems, some of these robotic companies, they really don't know what it's worth, and they're really worried. And so they're going to pay you even more because they're super scared.
Next week is
so we want to buy
critical
stocks
on
only
Google.
at cheap prices.
You know how to
If the
apply
stock has been
alpha-weight
trending
trader
up,
rules,
odds are it's not the
you will
case.
be able to
Now, sometimes they
identify
are. I bought a
you
stock
have the
recently,
opportunity to buy
WRLD. It was a
outside of this
recommendation we
level.
did.
But again, if you're acquiring long position
I don't even think I
outside
did a
of this
newsletter. I just gave a
area,
free
you're
presentation
a
to my
super
email list there.
duper
But
aggressive
it was
trader.
at near all-time
Because the
highs.
buying
We bought it
point
at like
was
what?
at 260.
80. Who's in here?
Buying
Who's one of the
here,
people in here? What did we buy this
this
like at
is their
87?
target.
87,
very
86?
late.
I don't know. Like a month ago, and it was near all-time highs. It's at about $100 a share now. I think it's going a lot higher. But as a general rule of thumb, here's what people don't understand. We're focused on seeing these uptrending charts, right? We look back at history, look at a monthly chart of an Apple or a Microsoft from back in '98 going forward, or an eBay, and we start to associate those uptrends with big profits. And so as soon as we start to see one, we want in on that. But everyone who made money, the Buffetts of the world and the Peter Lynches and the guys that are really looking for value, they're buying when things are getting beaten up. And the lower the price goes, the more earnings you're getting for your dollar, the more book value there is. There may have been some short-term bad news. And I'm not saying every stock at 52-week lows is a good buy. But normally when they're in a downtrend and it's been going down in price, it's presenting a better value for the stock. It's increasing the premium we get because the implied volatility is going up. Remember, bull market, implied volatility increases. Everyone's buying puts. Market maker has to sell them, right? Premium's going up. Volatility is going up. So now we're getting a stock that we like at a cheaper price. We're selling it at a price even lower than that. We're getting additional premium well above what that risk is worth to us. It's kind of a perfect mix. So this method is especially beneficial for me in times of overpriced markets. And I think today's current market conditions, I don't want to say it's wildly overvalued, but everything is at least fully valued, if not a little bit overvalued. And I'm just looking at, look, I study a lot of the historical market trends as far as how many times earnings the market normally trades for, and price to book, and GDP compared to overall market cap, and just historically look at the last 100 years, we're near the upper limits of stock market valuation.
What is Yahoo doing right now? Yahoo is
that's okay.
South,
there's still plenty of good opportunities out there, but when you're looking at traditional Procter and Gamble's or Johnson & Johnson's, the staple companies out there, most of them are trading at 18, 20 times earnings. They got a 2% dividend yield, and the time to buy those is when you can get them at 8 or 10 times earnings and 5 and 6 times % dividend yields. But in these conditions, it allows us to get paid for making what I consider realistic bids for stocks we want to own. And again, don't confuse this with selling spreads. Man, I really hate to say this stuff. I don't want to be a doom and gloom guy, but I promise you, almost no one makes money that way. It's like 99% there, but here's the difference. Everything we're looking at doing in this strategy, when you make it a spread, you negate it.
Thank you so much.
For 2 reasons. One, you're selling a put naked, but then you're buying another one that you know is going to zero. So you've given up some of your profit there, and you've taken the advantage you had away with the increased implied volatility of getting more premium than that risk is worth. The second thing is, if it goes down lower than you're expecting it to, you lose a lot of money. Like most guys will sell them like $10 wide, they're bringing $1, $1.50, $2. So like best case, I make 200, worst case, I lose 800. For me, worst case is I buy a stock I know is already underpriced, and I got paid to do it.
Thank you so much.
But that's the downside to me with spreads, is that if things go, they continue going lower, again, I can't predict what the market's going to do over the next month or 3 weeks or whatever, but you're not there to pick up the shares and then experience the profit when it rises and then sell calls and collect more premium as it's going higher.
You can see our students, you can see our graduates.
So I'm only using options as a tool. And that tool allows me to demand adequate prices from the market. Okay, it's like me going to a car lot, they're listed at 50 grand. I'm not just paying sticker. I'm saying I'll pay 40 for that one, I'll give you 32 for this one. I'm just making lowball offers. They're paying me to do it. I'm paying what I think it's worth. So the application is a twofold process, right? We're selling naked puts and stocks we want to own. If we're assigned, if the stocks are put to us, which is okay because we're not doing this on overvalued companies. We're doing this on ones trading at reasonable prices. And the price has gone down even further if they were put to us. And if that happens, we pick up the shares and begin selling covered calls at the same strike or a higher one, which is our calculated value, and begin bringing premium. So example I gave you at 50, if you sold the $45 put, you got $5, it gets put to you, now the stock's at 42, right? Then you start selling the $45 calls, you get another $5 in.
Thank you guys.
You end up buying it and selling it at the same price, but you made $10 a share on a $50 stock to do that.
Remember, trading room is
so you made a 20% return on a falling stock.
Space is limited.
Meanwhile, your friends that thought it was going down, they bought puts, the implied volatility was jacked, it skyrocketed. The stock began to push down. The IV came down with it. It popped back up. They got it, when it broke some trend line or something to that effect. They got out a couple bucks below, and they broke even and lost a little bit of money. You were dead wrong, and you profited. So in this method, we make extra money on the way in and on the way out. Now let me go over expectations for this, because I'll be the first to tell you, I'm not going to come in here and tell you can make 300% a year doing this. I'm not trading Forex pairs. I'm not risking the farm and everything. With this strategy, my personal target return is about 40 to 50% a year. And this comes from only investing in deep discount opportunities with high volatility. This is a stock that's a deep value stock. Horrible news, some big news just came out. It dumped hard. I'm selling it at the money because I know the stock's worth more. I'm getting really high premium, and I'm only investing in the absolute best ideas. This may only be, 7 or 8 trades over the course of the year. New practitioners of this, if you know what you're doing, I think you should target closer to 20%, and you'll probably be able to achieve this metric. And again, these figures are based on total capital at risk. They're not cooked numbers. It's not saying, well, if you use this leverage, technically you only had, $500 at risk and you returned 100, so that's 20%. No, this is based on you have all the money sitting there willing to buy all the stock. So if it's a $50 stock and you made $5 per share, that's 10%. So let me summarize and I'll answer all of your questions. The goal is to get paid to buy and sell stocks, not to guess at prices the stock may or may not hit. And you only want to apply this to undervalued stocks that you're willing to buy. I think a reasonable target for someone new at this is about a 20% annualized return on any put option you sell. So if it expires in a month, you want 1/12 of 20%. If it expires in 3 months, you want to make 5% on it, or 20% annualized return. And the best time to apply this strategy is when a company is experiencing some temporary bad news. Because it pushes the price down, you're now getting it at an even lower price, the implied volatility is jacked up, you're getting more money for the option. 40% is kind of what I look for, one IV above 40%. And then if a stock is put to you, you can choose. You can either hold the stock in your portfolio or begin selling covered calls, bring more money as you get out. And again, only selling puts on stocks that you want to own. That's what makes the strategy a win-win. Because if it goes higher and you didn't get put to you, you make money. If it goes lower, you bought the stock you already wanted at an even lower price, and you got paid to do it, you're going to get even more money coming in until you sell it by selling covered calls. Now, there's one final reason why I think the strategy will produce double or even triple the returns in upcoming years. This is a weekly chart of the VIX going back about 5 years. And before 08, this was kind of normal for it to be around 10 or 12. But as you can see from the last 5 years, now I should say I made this chart about a month ago, so I think is the VIX higher now? It probably is based on what's happened with the shutdown and all that noise coming out of Washington. But to give you an idea, when I made this maybe 3 weeks ago, VIX is around 13.7. Maybe it's around 14 right now. Gale's head's a little higher. But I'm not saying to trade this. I just want you to look at, over the last 5 years, it's been as high as 89. The lowest it's been in 5 years of trading is 11.05, and we're like 13 or 14. Do you think, going forward, there is a better chance of this being higher than it is today or lower than it is today? I mean, I'm guessing higher. I could be wrong. But when I see a chart like this, I think the odds are pretty good, considering it's only been lower than this for the last 6 months. Before that, it's never been this low in 5 years. The VIX is probably going to go up some. And when that happens and implied volatility goes up, what do we know happens? Option prices go up. Implied volatility goes up. Premiums increase, and we're making more money. Ed says it's 13.48 today, so it's actually a little bit lower than that. Okay, thanks, Ed. So where do you start if you want to do this? Well, the application is fairly simple, right? We covered the basic metrics. The difficult part really is stock selection. And it's not something I can tell you in an hour-long webinar. I love to. I actually did a 4-day course on it, like 6 hours a day, to kind of give you an idea of how long it takes. It's not an easy thing to do, just like trading futures or trading options or trading Forex. None of this is easy. You didn't learn any of this in an hour. But you need to know how to value a company so you can identify these undervalued opportunities. Now, if you are a skilled equity analyst, maybe you've studied this stuff, maybe you were trained, you may not need my help. I would encourage you to do your homework, be patient, and just trade cautiously. Now, if you were not a seasoned stock analyst, I can help you out with this. I've recently launched a service 3 weeks ago. We just opened this thing up. I'm really excited about it. So far, all of our trades are working out phenomenally, and I can show you those in a minute if you want. It's called the Income Report, and I just finished a 6-month beta test group. I took a set of hand-selected, really hungry traders and investors who wanted to do this, and I kind of put them through the gauntlet. I worked with them one-on-one to make sure they could execute the orders, they could do this. I made them dedicate their capital to it, and I made them guarantee they'd do it for 6 months. And afterwards, we talked, discussed the results. Man, it's fantastic. So I put together the Income Report. It comes out every week. It's a weekly newsletter. Every newsletter has actionable trades you can take. It maintains a complete up-to-date track record. I'm offering a full 12-month membership, which is 52 issues of this, plus bonus webinars and things. It was originally $149 a month, $1788 a year. I'm doing it half off at $895. Now, somehow my link is screwed up. Y'all will have to forgive me. Let me fix that. What you're looking at here is an example of one of them. This is one that came out September the 27th. Yeah, I'm broadcasting the wrong one. I am, in fact. Sorry about that. So it's bluetickresearch.com/now. No one passed my time, so I want to go ahead and get off here. But we put this out every week. And if you look at, this is, last week we did one on First Solar. Again, sold at 35, brought a couple of bucks in per share there. I sold at 37s for even more. And again, it's kind of the analysis that goes behind it. Right? We're looking at First Solar. Its revenues are growing. Its book values are growing. Its net income recently dipped, but it's popping back up. Its free cash flows are in the $380 million range. And I go through the company. I figure the book, how many times it's trading, what its market cap is, what they're holding in cash, what I think it's worth. Look at their free cash flows. And we put together, look, this is a good company. It's trading at a good price. And I don't have time to go through all this. But to me, the hardest part of the strategy is stock selection. You need to understand what you're investing in so that you're comfortable buying the stock. So if you guys want to take me up on this again, bluetickresearch.com/now. It's an entire year of this service, half off. I'm shutting this down at the end of the week, $895. I really appreciate you guys letting me on here. Jerry asked, could someone with a smaller account do this? Jerry, absolutely. I mean, I wouldn't say to do it with like a $5,000 account. I think the commissions will eat you up. But if you have, I'd say at least 15 to 20,000, yeah, absolutely. Absolutely. And Taz, glad you made money on that First Solar. All right, Yana, Morgan, I'm sorry I ran late. And if you guys don't know, Morgan's actually an old friend of mine. He lives down the street. And I apologize, but thanks for you guys letting me present. I had a really good time with you. If you have questions, please feel free to email me directly. It's just ross@bluetickresearch.com. I will respond to that personally, and I'll be glad to work with any of you guys I can. So thanks a lot, and you guys have a great evening. Enjoy the rest of the presentations.
All right, great. Thank you, Ross. I really appreciate you being here and also offering such an awesome discount to everybody. And, like you said, guys, this is not a get-rich type scheme. It's a good strategy that's been proven and tested by some of the biggest traders in the market. And so I think it's something that you probably won't hear a lot of people telling you about, but again, is a very valid strategy that's been tested and applied by the biggest people that are trading more money than probably anybody that you'll learn from. So thanks.